Welcome everybody to another live stream with Beanstox. I'm Chris Mangasser, Director of Investments. I'm joined today by our CEO, Connor O'Brien. How are you doing today, sir?
Hey, good afternoon. All is good.
Excellent. So we have three really useful topics for our audience today. Why you shouldn't wait to invest, the potential cost of poor market timing, and tips to help you decide whether to rent or buy a home. But before we jump in to the meat of our live stream today, Connor, there's something else on our screen here, 3 months free membership. Why don't you talk about that?
Right. We decided to do this, so people could get started, try Beanstox, invest the amount that they'd like to start with, get used to the weekly or monthly automated investing service that Beanstox also provides, check the portfolio that Beanstox provides to them, and so on, all without paying any amount for Beanstox service. So you get that for 3 months for all people who start during the month of June. So June has started, and it's a way to just encourage people to get their investments started now and during the month of June.
That's amazing. Great way to get started for sure. So before we dive into the topics today, Connor, maybe I'll pick your brain a little bit about what's going on in the markets, some market highlights you might want to share with our audience.
Yeah, sure. I mean, for the people that are new to investing, one thing that's generally been true over the decades, the very, very long term, is investing in stocks gives you ownership of companies. Companies tend to grow along with the economy, as well as whatever it is about the company that is good. Think of Starbucks or Costco or Walmart or Facebook or Google. These are all companies that are now very big. They created a good product, a good service. They grow not just with the economy, but with the success of their good products and attracting customers. So owning them is a good thing. Owning a lot of them gives you a way to diversify, meaning reducing the risk of any one company having a bad stretch. And so if you look really long term, owning stocks generates returns of something like 6, 7, 8% per year, not every year, but averaged out over a period of a lot of years. And so that's the long term. I'm going to probably remind people about that time and time again. Owning bonds is like owning a debt obligation that someone owes you money. The company owes you money, they pay you an interest rate, and then they give you your money back at the end of the bond time period, like a mortgage or anything else where you could borrow money. These days, lending money to companies is not so profitable. It used to be quite profitable, way back 20 years ago. You get paid over 10% per year to lend money to big companies. Now you get maybe 2, 3, 4%. And so it's not so profitable. So the long-term outlook we have for people is that better for them to have more of their Beanstox portfolio that's personalized for them, invested a little bit more toward the equities, the ownership of the companies, than towards the bonds, or let's call it lending money to companies and the U.S. government and some of the ETFs. So it tends to be more allocated towards equities. So that's the long-term story. The short-term story, there's some really entertaining things going on in investment markets. We don't invest for entertainment, but we do see what's going on. I think a lot of people have heard about GameStop and the stock that was an old-fashioned retailer of secondhand games, video games and stuff, a bit like a Blockbuster Video is an old-fashioned way of getting access to video copies of movies. GameStop was on its way to not very good prices, and then it just became a hot story, and a lot of young people said, "Hey, I'm going to pile into this, and I'm going to stick it to the man." Talk about hedge fund managers, the Wall Street crowd. Let's just stick it to them. And sure enough, it actually caused a lot of pain for some of these big institutional money managers, the Wizards of Wall Street, suffering a bit there. So what happened yesterday, that's like a sequel to the whole thing. It's funny that it's with the movie chain, AMC, the movie chain, really doing poorly through the pandemic. In fact, for 5 years, their revenues have been declining. But again, the stick it to the man thing happened, and on Reddit and everything else, the promotion of this idea of, hey, let's buy this and push, the Wall Street Wizards into a corner of pain, pushing up the price of a stock on which they bet that it will go down, and see what happens. Well, guess what? Yesterday it went up by about 100%, and what's happened today is the opposite. It's actually been fading. The company AMC decided to do a stock offering.
That's right.
So now there's more supply of this stock, and there's no brand new fresh demand that's commensurate with the supply. And so the price is coming off. Anyway, that's kind of the entertainment in the marketplace today. It's down 11% on the case of AMC. Beanstox does not buy any of these stocks directly for clients. We buy highly diversified exchange traded funds. Those are the building blocks of client portfolios. But we do watch what's going on in the markets. Sometimes it's entertaining but not important. Sometimes it is very important, and it's a blend of those.
So before we jump into the topics, what are your thoughts on meme stocks, on trading versus investing? How does that fit in an investor's life?
Yeah. I think that the core of anyone's wealth should be invested in a way that reflects and respects the amount of work they put into building the wealth. You just can't go wing it, rolling a dice, hoping you hit it lucky with all those, 40, 50, 60 hours of work per week. You're not just going to roll a dice on losing all of it. So our view is people should have their most important part of their wealth invested in a way that's extremely diversified and designed to grow, but also done in a way where there's no one stock that could take you down. It's not a lottery ticket. It's not Vegas. Now, some people buy lottery tickets and they go to Vegas. That's the kind of money we think people can do what they want with. If they're willing to go to Vegas with it, well, maybe you can actually do better buying some of these Beanstox and have some fun. But I would suggest people be extremely careful because they can disappoint quite rapidly if you get it at the wrong time. That's
great info, Connor. So let's hop into the slides.
Yeah, so let's go with this. Why people shouldn't wait to invest. And it's all about giving your money time to grow. Just imagine you were Jack in the Beanstalks and you had a handful of beans and you want to plant them and start growing whatever the beans are going to grow, your trees, your farms, or whatever it is. If you actually haven't put that to work, nothing grows. So you got to put your money to work for it to then begin to grow. This chart shows something pretty surprising. It shows that if someone invested same amount of money every year, $5,000 every year for 40 years at an 8% return, that's roughly what the equity markets have done over the last 40 years, it would grow to $1.295 million. So 1.2 million, almost $1.3 million over that period of time. 5,000 a year is roughly $100 a week, which is one of the suggestions we make with Beanstox, and people can have that automated and done for them. No guarantee of what exact return they're going to get, but they're going to get the growth that the market provides and the portfolio personalized for them provides. So in any event, 40 years can grow to that level. What about somebody who waits and says, well, I'm going to do nothing for 15 years. I'm going to start later and I'll invest more later. So that person, let's say they invest $10,000 a year, but they didn't invest anything for 15. They started 15 years later than the first person. Their money is not going to catch up with the person who started 15 years sooner. So they will have put $250,000 of their money into a portfolio, and because they didn't give it as much time, it would only grow to $731,000. They've put more money into the portfolio, but they actually have less wealth by about $564,000. The message is, give your money time to grow. Start investing as soon as you can with the amount that you can. Stick with the discipline every week or every month, a disciplined amount of investing. If you want to do it yourself, that's fine. You can do it yourself. Beanstox can automate it for you and give you the discipline, the consistency of investing the amount that you choose to invest.
I think this is a powerful chart. It really highlights that procrastination can cost you upwards of $500,000 in this hypothetical example. I think it underscores another important concept we've touched on in the past that maybe we should review again, which is compounded returns, Connor. So what are compounded returns?
Well, compounded returns basically give you growth on the growth. That's so, right. Every year, if your money grows, let's say 8%, and you invested, I'm going to use round numbers, you invested $100 and it went up 8%. Now you have 108. When it goes up another 8%, the 100 goes by 8, but the 8 also grows by 8%.
That's right.
So all of a sudden, that second year, you're getting $8.64 of growth on what you had at the end of year one. And then the subsequent year, it keeps on growing even faster and faster and faster on that initial investment amount.
And that's why those lines are curved, right?
That's it. That's it.
All right. Thanks, producer. Let's move on to the next slide, please.
Market timing. Chris, what do you think about market timing?
I think it's extremely challenging. And I would just be very careful for those who think they can market time. It's very unpredictable and it's difficult to do. Even seasoned professionals have a hard time market timing. So with that, I think I'll turn this over to you, Connor. You can take us through the slides, the potential cost of poor market timing.
Yeah, and what is market time? I guess let's touch on that for a second. It's kind of taking the approach that you can choose, select, guess correctly when the market's going to go up or down. Which are the days when you want no money invested or more money invested? And I think if it was easy, the whole world would be full of billionaires.
Yeah. Right.
And so what this chart shows you is the incredible cost of getting it wrong just by missing over the course of 10 years. If you got it wrong 5 times, 5 days where you just didn't have your money invested because who knows, you were scared or you believed the market was going to go down and it didn't, in fact, didn't, it went up. Just those 5 days would cost you massively. So let's say you had this money invested for 10 years at $10,000 for the last 10 years. It would have grown to $38,299 using the S&P 500 stock index as the measure. If you'd missed the 5 best days of those 10 years, you wouldn't have 38,000. You'd have 26,568. So you would have missed $12,000 worth of growth of your wealth just by missing those 5 days.
Huge difference.
Huge difference. Here's the other thing. The really good days often follow really bad periods. What happens is the world's falling apart, stocks drop, and then a very big positive thing happens. The government or the Federal Reserve Bank or some other major influence decides it's time to fix the problem. And, these expressions, it's always darkest before the dawn and things like this. When the problems get really, really bad, someone with a massive amount of money, it's the government or it's the Fed or similar, they show up and solve the problem, and the panic selling stops. It becomes panic buying, and the market lurches up by sometimes 5-10% or more. That's the problem with selling when you're scared. The solution comes along and your money's not invested, and you miss the benefit of that big solution.
So key takeaway here is stay invested, stay disciplined. Is that what you're getting at?
100% what we're getting at. Yeah, people can guess with small amounts of money. Don't guess with the big money.
That's great. That's great info, Connor. Okay, we can move on to the next topic. A little bit of personal finance. So tips to help you decide whether to rent or to buy your home. Let you take us through it, Connor.
Yeah, so I think this is interesting for everybody to think about, unless they happen to be living somewhere where the rent is free or they already own a home. The math is not so simple, but this illustration shows you what to think about. The first thing is think about your own situation. What you want to do and what you can do aren't always the same thing. So the decision should be based on choices you can make. What's your income? Do you have money for a down payment? Do you have a credit score good enough that a bank will provide a mortgage for you to buy the condo or the house? And do you have other debt that would enter into the calculation? If you have credit card debt and so on, that's a big part of the math. Maybe it could be harder to borrow money. So look at your own situation. The second thing is think about how long you're going to stay in that home if you buy it. The tax man gives you a terrific tax break on potential gain on selling your condo or your home if you've lived there for over 2 years. So if you're going to live somewhere for over 2 years, the math gets better. Think of it that way. There's no guarantee that the value of a home or a condo is going to go up. Historically, it has been the case, and that generates potential gain and gives you a potential tax advantage gain as well. The third thing mentioned here is check your price to rent ratio. There's some cities in which the cost to buy a home or a condo is incredibly high and just beyond reach, and in others where they're great deals. City 1 and City 2 listed here are real cities pulled from the database that happen to be the highest, most expensive home price city. I believe it's San Francisco, and the least expensive major city, I believe it's Detroit. And I think Detroit's actually coming along quite nicely in terms of improving this downtown core and the valuations of homes and things there. not forecasting anything. I just know that that's the trend that people are observing. Whereas San Francisco has become incredibly expensive. So let's say the monthly rent in San Francisco is $1,000, annualized, multiplied by 12 is $12,000 to rent a place in San Francisco. Of course, for $1,000 in San Francisco, it's not going to be very big. My daughter's going to be working there in the summer, and she's squeezing into like a shared apartment, and I think she's spending a little bit over $1,000 for her corner of the apartment. But think of the $600,000 versus the $12,000. That basically shows you a ratio there of 50 times. The value of the home or condo is 50 times the cost of the annual rent. The rule of thumb out there, not ours, but out there in the world of financial advisors on this, is if the ratio of house price is more than 20 times the annual rent, you should be thinking about renting, not buying. Whereas if it's below 20 times, you should be thinking about buying instead of renting. So think of it in city two, and let's assume it's Detroit. You could buy that house for $60,000, or you could rent it for $1,000. So $12,000 a year is actually a huge percentage of the cost of buying the place. I mean, look at that. That's basically 20% of the cost of buying would be your rent. And so starts to look like a very high percentage. So why not buy? So the final thing is the tip at the bottom says, well, what's the potential for the house price appreciation, price going up? Of course, house prices can also go down. You want to think about it. It's very city specific. It's very neighborhood specific as well. And the history of U.S. housing markets shows that houses generally go up except at times of crisis. And crises do happen maybe once every 10 years. There's some kind of a major price reset downwards. But generally speaking, the trend is up. I would suggest that one part of that trend is likely to continue, one of the key drivers, which is economic growth and population growth. The other part, not so likely, which is mortgage interests have got cheaper and cheaper and cheaper over the last 10, 20 years. Now mortgage interest rates are so low that it's very, very unlikely that they'll go a massive amount lower. If mortgage interest rates are 2% and they used to be 12, well, they've gone down from 12 to 2. That's a decline of 10%. We're not going to go from 2 to minus anything, minus 10%. No one's going to pay you to borrow the money. So that characteristic isn't going to repeat. But the population will probably keep growing. The economy will probably keep growing. Inflation will probably tick along. All of these things help support house prices. But be careful. When you buy a house, a broker is getting paid to provide the service. And when you sell, they're getting paid to sell it for you. That takes away usually around 5% of whatever you're going to get from the actual selling price. So short-term buying and selling is extremely tricky because you've got to overcome all of these things. Longer term, probably more of a steady, reliable thing to think about. Buy in a good neighborhood, buy a decent property, take care of it, fix it up. You can probably make a bit of money on tax advantage basis as long as you live there for over 2 years.
Connor, thank you. It's fantastic info. Thanks for walking us through the math. I think we're going to wind up pretty soon. But before we do, any parting words of wisdom, any closing comments?
Well, I just want to remind people of the 3 months free offer. I think this is just a great way for people to get started. If they're already using Beanstox, please encourage somebody else to give it a shot, take a look at it. And I think if you haven't started investing or haven't started using Beanstox, do the same thing. Try it for yourself. Even if you're investing some other way, picking your own stocks and so on, consider using Beanstox for a core portion of your portfolio. And if you have comments, please send them in to support@beanstox.com. We'd love to hear your suggestions.
Well, thank you everyone for joining us today. I hope you found the info useful. Again, as Connor mentioned, if you have any comments, send it over to our team. We'll take a look at them and try to respond to everything. Connor, thank you for joining us today. Thank you for the info, and bid everyone a good day.
Great. Thank you, Chris.
Thank you.